Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, April 12th, 2022, and I'm on, as always, with my partner, Dominick Tavella. How are you, Dom?
Good evening, Mike. Doing well. Looking forward to springtime finally getting here and some nice weather. So hopefully the markets will be in equally as good mood going forward, but glad I'm here.
Yep, it's a beautiful sweater you have on, but I think it's time to retire it, and hopefully some short sleeve shirts will be in order sometime soon. You mentioned the market. Oh, first of all, let's tell our audience, we decided a couple of shows ago that we would do a show in the beginning of every quarter where you and I just went over the market and talked about the headlines and the topics. And that's what we're going to do this evening. So it's going to be me and you speaking for about 40 or 45 minutes. And there really is no shortage of topics to go over, Dom. But just a quick recap of the numbers, which will be our jumping off point. So the numbers aren't great. They were a lot worse maybe a month ago, but they're not beautiful by any stretch of the imagination. The S&P 500, Dom, was down about 5.5% through April 7th. The Dow Jones was down about 4%, and the Nasdaq, which really got hit the hardest, was down a little bit more than 12%, but at some point it was basically down 20%. So we had a little bit of a rebound, Dominic, but like I said, we've had a long overdue little bit of a correction in the market the first 3 months of 2022.
And obviously anybody that's been listening to us or watching these shows, we've had a very volatile year so far, and we can underline very. We went through all of last year, Mike, without so much as anything over a 5% pullback in the markets. And this year it's been the exception where we see in some investment classes a 5% move in a day.
Mm-hmm.
So those are the numbers for the major indices. They're slightly worse today, but I don't know. Is that the glass half full or the glass half empty, Mike? Because there are specific asset classes and individual securities that are down 40, 50, 80%.
Mm-hmm.
Sometimes the indices really mask how bad certain parts of the market really have performed.
So let's get into that for a little bit. To your point, communication services, which really was parsed out of the technology sector a couple of years ago. So communications was down 13.5%. Technology in general was down 12%. And this one's interesting, Dominic. Consumer discretionary was down 11.8%. And the thing that's always kept the economy afloat is what? Is the
consumer, right? One of the things that has kind of been a religion for us in terms of making investment decisions is the health of the consumer. If basically we're looking at a U.S. population that has jobs, is making money, their savings rate is high, the level of their debt is low, well, then you have a pretty strong economy, right? As we've mentioned many times, the consumer represents 70% of the economy. So this is an asset class that should have done really well, Mike. Mm-hmm. So what happened?
What happened is headlines happened, right? Recession, war in Ukraine, interest rates, inflation, supply chain, high gas prices, Dominic. There were a lot of things that scared off investors who may have said, well, maybe I don't need that flat screen TV today. Maybe we'll hold off on that home improvement. So what happened was, I think the headlines have really caused the consumer to slow down their spending.
Yeah, so we're gonna pick one of these issues at a time and kind of cover what the market thinks, what we think, where we think we're going to go. But generally speaking, if we want to talk about volatility and headline risk, right? This is the definition of headline risk, where it seems like almost every day there's a headline about what's going on in Europe, or how bad inflation is, or politics, or economy, and the market reacts, right? The market is us, investors, individual investors, and institutional investors, and we react, going, hey, I'm feeling better, and the markets will go higher because you have buyers coming in, or gosh, I don't really feel so good about the future, and money comes out and prices decline, right? So we're in a period of, in my opinion, extreme volatility. And frankly, it pains me, but I don't see that going away anytime soon. I think at least for the foreseeable future, we can continue to expect these roller coaster ups and down periods.
Absolutely, because if you really think about it, all of these headlines are interconnected. So we could sit here and say, well, the consumer discretionary slowed down because buyers, consumers are nervous, but you could also argue that consumer discretionary slowed down because the supply chain pipeline has not been freed up, and there is no inventory of cars. If you want to do a home improvement, you have to wait forever because you can't get supplies, you can't get cabinets,
or if you are able to get them, Mike, the cost is so exorbitant. I had a client who was looking to build a house, and the contractor said, just wait a year, don't even bother. So when you think about something like that, and it's only one house with one consumer, right? But now all of a sudden they're not buying the lumber, they're not buying the tile, they're not buying the roofing shingles, they're not buying the sheetrock, they're not employing the workers that come in and do all the work. And I can go on and on. The economic impact of not building that one singular house just cascades through the entire economy. So it's the worry, it's the stress, and it's the headline that is getting people to change their behavior. And ultimately, that has to slow economic growth.
It absolutely has to slow economic growth. And then just when, we think our cup is full of headlines, in the last 10 days, we touched upon it briefly last week, people in the media and on Wall Street are really now talking about a potential recession, and look, we are months away from even remotely knowing if we're going to be in a recession. But if it's a headline today, and I'm getting calls from clients, you're getting calls from clients, well, what are we going to do about it if we're in a recession and we're not even remotely close to being in a recession?
So I know this is one of your favorite topics or pet peeves, Mike, but it seems like every other person on TV is adamantly calling for a recession. And even if they're not adamantly calling for a recession, they're at least talking about it, right? And it's sort of like if you wish it, it's going to happen. If you put it out in the universe, it's going to happen. People are starting to talk about it. People are starting to worry about it. And that, again, changes behavior. Maybe I shouldn't buy the car. Maybe I shouldn't take the vacation. Oh, the market's not doing that great. The minute you and I stop spending money, the minute one of our clients stops spending money, that's a little bit of a brick in the wall here of the economy being able to move forward. It kind of slows it down, and we don't want it to stop. The Fed clearly wants it to slow down, but we don't want it to stop. But I think you're absolutely correct, Mike. I think right now, talking about a recession is you could talk about it, but I think it's just silly. I really just think at this point, it's way too early in the process to talk about a recession, certainly this calendar year.
And to use your phrase, not to get too wonky, the reason that became a topic is because the yield curves inverted, I think a week ago. And what that really means in plain English is that the 2-year Treasury note was basically higher than the 10-year Treasury note, which in theory makes no sense, because if you're willing to go out longer term with something you own, you should be paid more. Every now and again, they flip-flop, and that's what causes the hyperventilation.
And I'm glad you used the word hyperventilation, Mike. We've gotten it from certainly from clients, which is justified. This is not their area of expertise, but I've witnessed it. I'm guessing you have too, based on your smile. These experts on TV who are like, "Oh my God, it's invert," as if somehow this is the all-seeing eye and the predictor of all things of the future. It's not. Can we just please get it out there to at least our clients and our guests and our viewers that the inversion, we have never had a recession without the yield curve inverting. On the other hand, every time the yield curve has inverted has not led to a recession. So they get half the story correct about you need to have the yield curve invert to get the recession, but they don't get the other half of the story, which it doesn't cause a recession and is not always an indicator of a recession. So that was a lot and a little wonky. I'm sorry, Mike, but the key here is it's not the doom and gloom yet that some people are predicting that it is.
Thank you for explaining that in plain English, Professor Tavella. That was Economics 101. Nicely done.
Well, thank you, but I'm sure we'll continue to get calls on it. And I'm sure there'll be the panic mongers on TV that will use that as the proof positive that the markets will go down 30 and 40 and 50%. That was sarcasm.
No, I hear you. So listen, we got to take a quick break. And when we come back, we'll talk about some of the good things that are going on in the market and the economy, because believe it or not, there are some good things going on as well. So we'll be right back after a quick break.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. So Dom, we just touched on a recession, possibly. Before we worry about a recession, could we at least get through inflation? Right? Could we at least do that first and worry about interest rates going up before we worry about them going back down as a result of the opposite happening?
And they obviously they're all linked, right?
Of
when
course.
we talk about recession and inflation and interest rates, we're dealing with a scenario where, because of exceedingly high inflation, we got a really ugly number today. It was over 8% year over year, and we expected it. The markets expected a really ugly number. The Federal Reserve is in a position where they have to raise interest rates to slow the economy down. The 30-year mortgage, Mike, now over 5%. That's a pretty big jump, right? So the key here is the Fed is looking to slow the economy down so prices don't rise as much. And they're doing this by A, raising interest rates, and B, deleveraging themselves of the balance sheet. We won't worry too much about that right now. The key is interest rates are going higher. Theoretically, inflation should go lower by year end. But will they do this? Will they create the soft landing for the economy, or will it be a crash and burn because they've raised interest rates too high, too fast, and the economy comes to a dead stop? $1 million question, Mike.
Right. I mean, look, and that is the dance that they have to do. And every move, every signal that they send out there is obviously parsed 1,000 different ways. When they first announced they were going to raise the Fed, they were going to raise interest rates. The anticipation was it would be 25 basis points or 1/4 of a point every time. Now the expectation is, Dom, at least in the next meeting for sure, they better raise it 1/2 point, and maybe even the next time after that. And if they don't, the market will be nervous about them not raising interest rates fast enough.
So literally every noise that comes out of the Fed, every Fed governor that gets out and does an interview, the mood of the markets change. What I like to remind people is that this same Fed 6 months ago was saying that inflation was not a problem, and they perhaps were only going to raise interest rates 2-3 times. 6 months later now, their whole stance has changed dramatically. And I'm not saying they're right or they're wrong. I rather give them the credit that they're reacting to data that is different today than it was 6 months ago. But how do we know what the data is going to look like 6 months from now? So trying to predict what this Fed will do 6 months from now, at best, is a guess, Mike. At best is a guess.
Dominic, they will never live down calling rising prices of everything transitory. They'll just never live it down.
Mike, and again, I hate to do this, but you might remember in many of my interviews that we were saying, yes, inflation's an issue, but the word transitory does not mean 3 days, 3 weeks, or 3 months. It could possibly mean 3 years. Our own Dr. Siegel, in one of the interviews we've done right on this podcast, called it spot on. He thought inflation would be a problem for a 3-year period. And I think, honestly, he's a lot more accurate in his forecasting than the Fed was. But my point here is we don't know what this picture is going to look like 3 and 6 months from now. And trying to predict it, I guess that's our job, but it's not an easy job. And probably the scenario is not going to be what we think it is.
A year ago, one of us was probably on this podcast saying that the people we talk to are predicting that the supply chain issues will be resolved by December or November of 2021. And to your point about your client who wanted to do construction, I had a contractor, we wanted to redo a bathroom, say to me, why don't we hold off a year because things will be cheaper a year from now. And here we are a year later, exactly the same place. So obviously the Federal Reserve has access to better information than we do, but we were hearing the same things that the Fed was hearing, and everyone was wrong.
Yeah, Mike, and I really, I don't want to be funny when I say this. I'm not trying to be sarcastic when I say it, but I don't know if they have better information than you and I do, because we actually speak to our clients who actually live, breathe, work, retire in the real world. So they shop at the Home Depots and they go out and try to buy a car and they try to actually renovate a house. So they're dealing with real life, real time issues. And we get that information daily when we have conversations with them.
No, you're right. And I think you and I talked about this offline. You know, I have a client who's an event planner. And she was telling me that what used to be $100,000 party, which to me is insane. But anyway, people spend that in New York City, now costs $150,000. And there is a pain point even for those people who are balking at spending that type of money and are just cutting things out, which again, to what you said earlier, if they're not buying all the flowers, they're not buying all the food, that trickles down ultimately to everybody.
And Mikey, I know you've brought this up in the past, but you know what? Maybe going and gassing up your car and it costs an extra $20.
Mm-hmm.
In the real life, that $20 for most people is not going to dramatically change their life. On the other hand, psychologically, you go, oh, I can't do this. And all of a sudden you change your spending behavior. So even people that theoretically can afford this higher cost, the minute they change their spending behavior, that has economic impact. And frankly, that's what the Fed is trying to do, right? They're trying to change the scenario where people will spend at just about any cost. And by slowing spending down, they slow the economy down, they will lower the inflationary pressure on the economy. So whether we like it or not, that is what's going on.
And when they raise mortgage rates inadvertently raise mortgage rates to 5%, that slows down a huge part of the economy, and that's the resale of homes and new home construction.
So on the home side, if I can say the good news is, because it's not good news for a new buyer coming into the market, even though prices are really high and the cost of building is really high, the amount of new building going on is still not enough to meet demand. So that should keep real estate prices relatively healthy for the foreseeable future. But in terms of the new buyer coming into the market, it's a real challenge, Mike. I mean, at least if you own something and you're selling it to buy something, you've had appreciation in value in your home. But if you're a young person or a new person coming into the housing market, this is really a tough market. This is really tough.
especially where we live, Dominic, and here on Long Island, we've been lamenting for years that really the middle class and young people, our children trying to buy a home on Long Island, it's very, very difficult to do that on their own. I mean, the middle class, that's the unfortunate part when interest rates go even up a tick or two. It makes it even harder for those folks to stay somewhere like Long Island. If they want
And
to.
Mike, both you and I have experienced this firsthand and secondhand being our clients, but that's why you see this mass migration from high cost states, right? New York and Connecticut, New Jersey, Illinois, California, to lower cost states because the affordability factor. And there's other reasons as well, but climate, but affordability.
No, absolutely. So Dom, let's talk about a little good news. We mentioned Long Island. The restaurants are still packed every weekend. You still can't get a table. There's still people obviously in Home Depot buying things that they need. And one statistic I heard, which is remarkable to me, that the Masters tournament was over the weekend last weekend, and someone told me that in the swag store where you buy Masters merchandise, people spend $800,000 a minute for 4 days. So people who are determined to spend money are spending it if it's important enough to them. If everything is not dire.
So there's 2 points you made there, Mike. The first is that the employment numbers are, now we had a lot of people leave the employment world, whether it's retirement, whether they got laid off and don't choose to go back yet. We have, I think at last count was 11 million open jobs in this country, and the lowest unemployment rate that we've had, I think dating back to the 60s or the 70s, some crazy stat. So the employment scenario is phenomenal in this country with good wages, good jobs, and a lot of open jobs if somebody wants to move and go to a different career path or a different state to work. So the employment scenario is fantastic. Wages are growing, and not as much as inflation, but they are growing. And the balance sheet, meaning how much debt the consumer is carrying versus how much money they have sitting in the bank, is extraordinarily healthy right now. So we've mentioned many times the consumer is 70% of the economy. As long as the consumer is financially healthy, forgetting about psychology for a second, as long as they're financially healthy, the economy is on pretty good footing.
It is on pretty good footing. And just a quick note, our Zoom technician, Scott, corrected me. They spend $800,000 an hour, not a minute.
Wow.
It's still $8 million a day. It's a lot of money.
Look, you brought it up, Mike. Try going to a restaurant, try going on an airplane, go to a hotel. People have been locked up for so long. They are looking to break free. And of course, we haven't used the word COVID once yet.
I know. It wasn't even on my list.
How long into this show and we haven't used the word COVID one time? Thank God. But that scenario keeps getting better. Hopefully it stays that way. And that lets us, free at last, right? We can go out there and live our lives.
And hopefully, I think, you touched upon the unemployment number. The unemployment number is also at a decade's low number. So we're getting this wild inflation number we haven't seen in decades. We're also getting low unemployment we haven't seen in decades either.
It's all makes for a very healthy consumer again, which is terrific for the economy. If we switch this over to corporations, they're equally healthy. Strong balance sheets, lots of cash on their balance sheet, good, strong dividends, earnings expectations. We're in this quarter. I think people are going to be surprised. They're talking about earnings growing by about 5%. That might be in the low end of the spectrum. I'm hearing whisper numbers in the 7 to 8% range. So we might get a pleasant surprise this quarter with corporations' profits being substantially better than analysts are estimating right now.
And we always feel that sometimes these estimates come out a little below so their stock doesn't get killed if they wind up disappointing. So Dom, tell me what possible headline would you look for that would help the market a little bit, give the market a boost, something out of clear blue sky that would cause people to breathe a sigh of relief?
I think the first one, Mike, which is again more psychological, but if there was some kind of, I hate to use the word resolution, but at least a ceasefire, a peace agreement in Europe, I think that would take a great deal of stress from the markets, because that might be, thousands of miles away, but we are all living it, breathing it, watching on the news every night, and there is economic effect via the price of oil and natural gas and prices of goods and services that come out. So if we had a peace agreement, if we had a ceasefire at a minimum, that would help out a lot. But I think the next largest event we're looking for is, will inflation stay this high for an exceedingly long period of time? Or, and we're starting to hear the whispers, the experts going, maybe this is the peak, a little higher, but maybe this is the peak of the mountain, and slowly, but it starts to roll over, and maybe by year end, it's not quite as horrific as we got this morning. That would be interpreted extremely positive by the markets and consumers.
Absolutely, because as we said, all these things are interconnected, right? So if inflation starts to slow down, then maybe the Fed doesn't have to tap on the brakes as aggressively as anticipated. Therefore, there's not the risk of them not being able to negotiate a soft landing, which then would therefore have us potentially avoid a recession. And here we are a year out.
Yeah, Mike, I'm sure I'm going to get this wrong, but when we were kids, we used to play with that game where your finger bone was connected to your wrist bone, that was connected to your elbow. Well, this is it, right? It's all intertwined today in a global economy. You mentioned, the pipeline of commerce being frozen around the world. They are starting to open up. And not completely. We're not where we need or want to be, but I'm starting to hear rumors that the auto manufacturers are getting computer chips so that they can go ahead with building cars. Something as simple as that means new cars become available. And if new cars become available, used car prices, which are a really big component of inflation, I think for the first time in a very long time, used car prices started to come down, Mike. So, supply chains open up a little bit. COVID is not as catastrophic around the world. Maybe we get some kind of, I don't even want to use the word resolution in Europe, maybe not as much inflationary pressure. I know I'm kind of trying to paint a real positive picture here, but it's not an outrageous, impossible picture.
No, it's not an outrageous, impossible picture at all. And let's not forget, the Fed is not run by Mo, Larry, and Curly. I mean, these guys, I still maintain, did a great job 2 years ago navigating the Fed and the economy and the overall market through an unprecedented shutdown of the entire economy. And let's not forget that that's who's still at the wheel now. And these are really smart people, and hopefully they could, figure out that soft landing.
Yeah, the comment I made earlier, Mike, I didn't really want it to come off as criticism that 6 months ago, the Fed looked at the picture this way, and now all of a sudden they're looking at the picture in a different light. As much as they are reacting to the data that they have in front of them. And the data 6 months ago was very different than today. My gut feeling is the data 6 months from now is going to look very different than it does today. And I think the Fed is going to be smart enough and hopefully sensitive enough to react accordingly, and they would never intentionally push us into a recession, but certainly if they slam the brakes hard enough, they would. I think they'll be sensitive enough to the issue that they won't.
And I tend to agree with you, obviously, which is why I made that comment just now, how, the Fed's being run by some pretty competent people. But, we can't end this show, Dom, without giving a little attention to the bond market, which, let's just face it, it's been, again, decades worth of really, really ugly returns right now.
Look, and you and I hear it every day, Mike. We literally have clients that have said to us, I've never seen a bond price go down. And maybe they weren't looking, but the point is we've gone through decades now of interest rates going down. When interest rates go down, bond prices go higher. So not only were you collecting your interest, but you were also collecting some appreciation in value of
Mhm.
the underlying bonds. That seesaw now is working the other way, not likely to get any better anytime soon. We just hope it doesn't get worse.
Yes, we obviously hope it doesn't get worse, and one of the reasons we get this imbalance is because the bond market is not priced as efficiently, Dominic, as the stock market, right? There are literally hundreds of dealers out there, all shaving a quarter or an eighth or a 16th, and the bond market, selling creates selling, and that's where we are right now, especially with the retail investor, where they just reach the point and say, this is not what I expected. They'll call their financial advisor or their 800 number at Schwab and say, sell my bonds.
Yeah.
And that's part of the problem.
Yeah, there's a lot of selling going on right now. Investors out there, especially those that don't have somebody to hold their hand through the process, are just indiscriminately selling. So there's a lot of selling pressure right now. Look, I'm less concrete on this particular issue, because ultimately it depends on what the Fed actually does and how aggressively they do raise interest rates. But I do in my heart believe right now there's too much selling going on, indiscriminate selling going on, putting too much pricing pressure on these bonds. And I'm not saying that's a buying opportunity. Normally we would look at it as a buying opportunity, but I certainly would be very careful about selling into this environment. If you can help it, look, you're reinvesting your interest, you're reinvesting your dividends, you're accumulating more shares at lower prices. I think the longer term, hopefully the longer term solution here is that it softens the blow on bonds, and maybe by year end they won't look as ugly as they do today.
And to your point, you have to, as an investor, you have to remember, why did you buy the bonds to begin with? You bought it for safety, which you will get ultimately, and you bought it for income. You made the decision on your own, or some advisor recommended you do that.
And look, let's not forget or remind our viewers, these bonds eventually mature. If you're holding individual bonds, they do mature at face value. And so you will get your principal back, again, if you're holding individual bonds. So look, everybody's going to make their own decision. We'll make the decisions on our portfolios of what we should hold and buy and sell, but don't be indiscriminately selling in this environment. It's usually a bad bet. We look at these things later on, weeks, years later, and we usually find out that that was a bad bet.
So, Dom, in conclusion, we had the first quarter of 2022 where we were inundated with headline risk, and I don't think that headline risk is going to go away anytime soon.
But we are well off the bottom, Mike. And that doesn't mean we're not going to bounce up and down and up and down. If you had sold again in March, you would not have been happy about that, because all the major indices have had a pretty significant recovery. We're not through this by a long stretch, and gosh, maybe we will be higher on year end than we are today. But considering the headlines we've gone through, Mike, we're actually not in a bad spot. The markets are not in a bad spot.
I do not disagree. We've already gotten back half the losses we sustained just a month ago.
And that's not a bad place to start the second quarter.
Right. So my glass is half full, Dom.
And mine as well, Mike.
So on that note, we are out of time, my friend.
Nice talking to you again, Mike, and catching up. and let's hope we go through a better second quarter than the first. But again, I'd like to end it positive. I think year end, maybe we're all a little happier.
I agree with you.
Looking forward to better days.
Absolutely. And we will see everybody down the road. Good night, everybody.